Question 61. According to the Fundamentals of Compliance section of the Global Investment Performance Standards, or GIPS, total firm assets must A. Not include assets assigned to a sub-advisor. We can rule that out since we will include assets assigned to a sub-advisor. We are picking the sub-advisor, and so it's just because the sub-advisor is the one making the investment decisions. Doesn't mean we wouldn't include it. B. Include non-discretionary and discretionary assets. So this is going to be correct. We are going to include non-discretionary and discretionary assets. And then C, be included in composites on the basis of their respective book values. This will be incorrect because this should be fair values, not book values. We want to hold it at the current market value, not necessarily the book value or carrying value. So we'll go with answer B. Question 62. Jason Briggs works as the chief analyst at Crescent Investment Bank. After issuing a general recommendation to all clients, Briggs invites the bank's largest institutional investors to discuss the recommendation further, as they pay an additional fee for the detailed analysis. Mr. Briggs has most likely A. Not violated any standard, B. Violated standard 3B, fair dealing, or C. Violated standard 5B, communication with clients. So our decision here is not violated versus violated, and then if we violated, did we violate? Which standard did we violate? So the key things we're looking at here is, were any clients kind of mistreated? And so after issuing a general recommendation to all clients, Briggs invites the bank's largest institutional investors to discuss the recommendation further as they pay an additional fee for detailed analysis. So this is going to be not a violation. The kind of bare minimum or service that we should be giving to all clients and treating them fairly is that general recommendation. So by doing that first, these investors pay additional fees for this analysis. And so there's no violation in him, in Jason Briggs, giving them further detail or providing some additional event to kind of talk about that or something like that. So there's no violation here. Where it would become a violation is if the recommendation was only sent to the largest investors. So if you send the recommendation to those investors first, because they pay more fees, and then you sent it to other clients, then that's where it would start to run into some issues. But it's totally okay to have different service levels for different clients, as long as we have kind of that general recommendation or given to all clients. Answer A. Hart is a research analyst at Time Associates, an investment banking firm. She's been asked to write a research report on Blue Ink. Time was the chief underwriter of Blue Ink stock when it had undertaken an IPO 2 years ago. In addition, 2 of Time's directors continue to hold a significant proportion of Blue Ink's shares. Hart's most appropriate course of action will be 2. So there's a bit of there's some conflicts of interest here. So Janice Hart's a research analyst at Time. She's looking at Blue, who the investment bank underwrote for their IPO, and some of the directors at her company hold significant stock. So the conflict of interest there is essentially, the investment bank obviously wants Janice Hart to write a favorable report to kind of help with their stock that they own shares in currently. So given that, what is the most appropriate course? A. Decline writing the research report due to the presence of a conflict of interest. This could be our answer. It doesn't necessarily have to be declined. I mean, this is a pretty common thing that happens in the industry where investment banks have sell-side research reports, and they have their brokerage arm. So there's naturally going to be conflicts of interest there. The key there is more so to disclose it. So A could be our answer if there's nothing else better. So we'll keep that on the table for now. B, write the research report and disclose the special relationship to clients. Sounds good so far. On a request basis. Nope. If we're going to write the report, we need to disclose it to everybody, not just if requested. So we can go ahead and rule out B. C, write the research report and disclose a special relationship between Time Associates and Blue Ink. So between this and A, I think we can confidently go with C. These, especially when you're getting into these bigger investment banks, like Morgan Stanley, JP Morgan, they're getting doing the majority of these IPOs, and they're going to have their sell side research, and there's going to be conflicts of interest. The key there is to make sure it's just disclosed. Answer C. 64. Gus Horace is a real estate advisor in a developing country. Horace is attempting to sell agricultural land to a restaurant chain to grow its produce. The land lies parallel to a river where industrial waste is frequently dumped. That doesn't sound too good for a restaurant to be producing food where there's a lot of waste dumped. In marketing the land to the potential client, Horace states, "This is a purchase you will not regret. You should more than likely expect to enjoy a healthy crop in your first year of farming." So this just seems very dishonest right off the bat. If we're going to have a lot of waste, maybe they can convert this land over time, but to say you're going to have a healthy crop in the first year, that's probably a little dishonest. So we probably have a standard violation there. Horace does not disclose that the original landowner is an acquaintance of his. Let me get rid of that so we can see. Horace is least likely in violation of which standard? Okay, so least likely, so we're violating two of these, but one is we're not in violation of. So A, fair dealing. Fair dealing would be some type of special treatment for certain clients, and there's not really any indication of that here. He's a real estate advisor trying to sell to this restaurant chain, but there's no indication that he's giving this restaurant chain any special treatment. In fact, he's kind of trying to screw him over. So fair dealing sounds like it'll be our answer and not be a violation, but let's make sure we can rule out B and C. Misconduct, we're certainly violating there due to our dishonesty around the land. And C, disclosures of conflicts. The landowner being an acquaintance is probably a conflict that should be disclosed. So we can say we violated there as well. Answer A. Question 65. To comply with the CFA Institute Code of Ethics, members and candidates should most appropriately A. Promote the integrity of the legal system. B. Place the integrity of the investment profession above their interests. Or C. Maintain their duty of loyalty towards clients, prospects, and employers. This is tricky because these are all good. Obviously, we want to promote the integrity of the legal system. We want to place the investment profession integrity above our interests, and maintain loyalty towards clients, prospects, and employers. So this is hard. The answer ends up being B, and I think you can kind of just think of it as like this being the overarching primary focus of the code in ethics is placing the integrity of the investment profession above your own interests. And by doing so, I think you the A and C end up kind of falling into line. If you're placing the integrity of the investment profession above your interests, you're going to be falling in line with the legal system, and you're also going to be maintaining loyalty towards clients, prospects, and employers. So we'll go with answer B. Question 66. Chris Tummings works for a brokerage firm. On Tuesday, one of his analysts mailed all investors a recommendation for XYZ company's stock. The following day, Tummings receives a call from one of his clients to sell XYZ at market price. What should Tummings most likely do? So we've got a recommendation that was mailed, so it probably hasn't gotten to the client yet who's asking to sell this XYZ. So what should we do with that? A, accept the sell order. This doesn't seem right without mentioning the mailed recommendation. So we'll rule that out. B, not accept the order because it is contrary to the firm's recommendation. We can rule that out as well. At the end of the day, the client is going to be the one to determine whether we're doing this buy or sell order. So it's not really, the broker is still kind of at the mercy of the client. They can't just not accept the order because it doesn't align with the recommendation. C, advise the customer of the change in recommendation before accepting the new order. That sounds very correct. It was mailed out, so it probably hasn't gotten there yet. So it would be best to tell them about that. And then if they still want to move forward, they can accept that sell order. If they don't, then they can part ways. Answer C. Question 67. Wallace Associates is a sell-side research firm with clients primarily from the financial services sector. Sarah Parker, a research analyst from Wallace Associates, has been assigned Midland Trust, Wallace Associates' most recent client. Parker is compensated with a primary research fee and agent options, which allow her to purchase 2% of her client's common shares if the stock performs well. After conducting thorough research using public sources, Parker determines that a buy recommendation will be most appropriate. She includes a minor footnote at the end of the report that discloses the volume and expiration of her eligible options. According to the Standards of Practice Handbook, has Parker most likely violated the code and standards? So key thing here is the compensation. So Parker's compensated with a primary research fee, no problem. The difficulty here where ends up being some problems is the agent options. It allows her to purchase 2% of her client's common shares if the stock performs well. So she clearly is going to have a vested interest in putting out a good report, because if the stock performs well, she's going to be able to buy common shares and then make money off of those common shares going up, assuming that her report has some impact. And maybe it won't, but it won't have a negative impact at least. So she's going to be very biased towards providing a positive report, which will be very biased. So this is definitely an issue here. So did we violate? Yes or no is going to be our first key here. So yes, did we violate? No, did we not violate? Yes, did we violate? We definitely, we're probably in some violation here with the type of compensation, because it's fogging our independence and objectivity. So A, yes. Why did we violate? Because her disclosure is not prominent. It says she includes a minor footnote at the end of the report that discloses the volume and expiration date of her options. That's probably sufficient. There's no set way to kind of disclose in the code based on the code and standards. So providing it in a footnote at the end is probably fine. So I think we can go ahead and rule out A, assuming C looks good. Yes, because accepting the options may impair her independence and objectivity. Correct, for all reasons mentioned before. If the stock goes up, she is going to benefit greatly. The proper way to structure it is just a flat fee for the research report, and then that helps get rid of some of the bias. So she wouldn't be like negatively affected or not positively affected by issuing a negative report. Answer C. Question 68. Francis Meyer is a derivatives trader at Walsh & Spencer. Meyer has put Laura Peterson, a trader serving the firm and reporting to Meyer. So Meyer is supervising Laura Peterson, in charge of monitoring trades executed for client accounts with low risk. Due to a hectic work schedule, Peterson inadvertently overlooks an accidental allocation of a high-risk equity stock to the accounts. According to standard 4C, responsibility of supervisors, Meyer is most likely. So we've got not in violation, or C, in violation. Let's look at these. So not in violation, as the standards do not cover Peterson's conduct. That's not true. Overlooking it's an accident, but overlooking that is going to be some type of violation. But we are looking at Meyer, and Meyer is supervising Laura Peterson. So Meyer is still responsible for any issues that Laura Peterson may create on her own. Not in violation once she has delegated her supervisory responsibilities to Peterson. We can rule that out too. Once you delegate, you're still in charge of monitoring and keeping an eye, making sure that there's some checks and balances in place to kind of help you review and make sure that the people you delegated responsibilities to are doing a good job and staying in compliance. C, in violation, because she remains responsible for her supervisory duties despite the delegation. That is our correct answer. We'll go with C. Question 69. Bill Kessler works as an analyst at Minecraft Investment Advisors. He is attending a private conference call with the CEO of another company in the cafeteria of his office, but the phone is not on speaker mode. During the call, he took notes of the earnings projections on loose sheets, but forgot to take them with him. The portfolio managers found the loose sheets and traded stocks on behalf of their clients based on the earnings projections mentioned in those notes. Who has most likely violated the standards? So we've got Bill Kessler, the portfolio managers, or both of them. So the material non-public information here, that's what we're violating. So it's the earnings projections, and this is a private call, so presumably this is not public information. So does Kessler violate by leaving the sheets behind, and then do the portfolio managers violate by trading on the stocks? So the portfolio managers definitely violate. They are acting on material non-public information. And so I think we can go ahead and rule out A. We're either going to have the portfolio managers or both. And then for Kessler, I think you can make the case that he's violating by kind of being loose, pun intended, being loose with his kind of loose sheets of paper. If he's in possession of material non-public information, that's very sensitive information, so we need to be careful with that. So we'll go with C. Both of them are violated. Question 70. Upon reviewing the materials received during the investigation of a professional conduct inquiry, the most likely preliminary course of action for a designated officer is to A. Revoke the member's CFA charter. This seems like a pretty dramatic first step. I mean, this is a preliminary course of action. To just go ahead and revoke the charter is probably going to be a little too dramatic, unless something really, really bad happened. B. Suspend the member's membership. I'm going to say this also falls under the same camp as A, where it's probably just too big of a first step, which is kind of what is implied by preliminary course of action. C. Propose a sanction which the member can reject. That definitely seems a lot more reasonable than immediate suspension or revoke of the charter. Answer C.